Diageo has just reported its earnings before the market opened, and we can in fact see it is down more than 9%, and it will take it to a new 52-week low. And one thing to note as well, it is now around 50% down from the 52-week high we saw at $177. Now, an interesting fact about this company, when we do take a look at Warren Buffett's portfolio for the Berkshire Hathaway, we can see it is one of the smallest allocations that does sit there. He holds around $33 million worth, and the price that he did pay sits around $149. Now we can see that is considerably higher than what it is trading at right now at around $119. So as we go through the episode today to understand why it has fallen so much, you can see whether or not you believe it is strongly undervalued and whether you should add this at a lower price than the great Warren Buffett himself. Now, one thing to note for those that don't know what this company is, it has many famous brands. It has Johnnie Walker, Guinness, Baileys, Smirnoff, Ciroc, many that are very well known in the industry. And what we really want to understand in today's episode is why they are down so significantly, and in fact have been continually on a downward trend for the last few years. Now, first thing that we do want to point out, this is a company that does trade in the FTSE 100, and they have had their net sales now down around 1.4%, and the management believe that this is due to two factors. The first one, the unfavorable currency rates, but in reality we do believe the majority relates to their second point around declining sales volumes, where consumers are effectively purchasing less of their products. Now, in terms of where this has seen the worst performance, well, that is coming from the Latin America and the Caribbean, where, as we can see here, down 21.1%. Conversely, when we look at Europe, we can in fact see that there was some organic sales growth, 3% as they mentioned, driven by Great Britain and Ireland as well as Turkey. We can also see one of the major drivers for growth was the strong sales that they account to around 18% jump in its beers to the brand of Guinness that they do hold under their umbrellas, as we just saw many major very well-known brands. Also, one thing that you never really want to see in a company that you're investing in, or in fact considering to invest in, is that their operating profits have fallen 4.8% to around $6 billion. The chief executive does talk about the issues they have faced in 2024. They talk about the macroeconomic environment worsening, geopolitical volatility, and what we have heard in other calls from the CEO, that they do believe they will start to see some of this poor underperformance continue into 2025. Now, what's interesting, we did report on McDonald's earnings yesterday, where they did reiterate the fact that they see the consumer environment becoming more and more challenging, with people having less disposable income to buy, whether that is fast food restaurants like McDonald's, like Taco Bell, or in fact whether it's their favorite brands of drinks, as we mentioned, Guinness, Smirnoff, and the likes. So something just to understand when we do look at this company, there are some real issues they have faced over the last year, as well as some that they believe will continue into 2025. Now, when they released their report on their website, we just wanted to highlight one or two things in case this was new to you. The first one was that they have at least held or grown their market share to around 75% of total sales, which is always great. That is a very strong, commanding amount in terms of where you want to see a very well-known brand sit. So that is a good sign. They haven't lost any of their market share. And the second point here is that they have increased the full-year dividend by around 5%. Now, we're going to take a look under the hood and look at the metrics about this company, as we want to understand whether or not we believe there are any long-term repercussions and how they have been historically in terms of some very important numbers. First one, dividend safety. It does look to be very safe. In fact, that is the highest score obtainable. And dividend growth, as we mentioned, a 5% increase. Now, what this 99 safe effectively means is that the dividend cut is highly unlikely, and ultimately they will be able to continue to increase it year on year. Now, for those that do believe we are heading into a recession, well, in fact, in the Great Recession 07-09, they increased the dividend. They had plus 5% recession sales. That was well above the average of negative 12% of the S&P, but they did have a near S&P return, negative 51, the S&P itself, negative 55. Dividend growth on this channel, we always like to see a minimum of 4% year on year, just to keep up in line with inflation. Over the last 20 years at least, at that 6% is nice to note, but as a general rule of thumb, we ideally want to see nothing less than 4%. They are also a dividend aristocrat, given they have 25 years of consecutive increases to their dividend. Now, ultimately, one of the things we look at for undervaluation is dividend yield theory, which states a company is undervalued when the current yield sits above the 5-year average. We get a severe undervaluation signal. What's nice to note as well, it does have a 99 very safe score, and when the market does open, this yield will be much higher given the drop we have seen in the pre-market, and we do believe it will drop further upon opening. Forward P as well, 17.7 right now. Again, we believe this will be lowered, but already we can see it below the 5-year rolling of 22.6. And we do note the consumer staples sector as a whole isn't that far off at 17.5. Now, free cash flow payout, something we always draw your attention to, below 70% for consumer staples. Why we focus on this? Well, the earnings is susceptible to manipulation by management through accounting, and on the free cash flow, we can start to spot any potential dividend cuts. 98% in 23 is very high. That means nearly all of the free cash flow generated by management was effectively paid out to shareholders as a dividend. We want that much lower. Nice to note it is coming down to around 79% expected over the next 12 months. There's something just to keep an eye on, as that will ultimately affect the dividend growth increase we see on a year-on-year basis. The next thing is the free cash flow per share. We want consistent increases over longer term. Now, we don't get that consistency, but it still has doubled over the last 10 years, and we do note over the next 12 months, they are expecting some very nice growth to the free cash flow itself. In terms of sales growth, well, 3 to 7%, we will look at this in a little bit more detail to also cover their bottom line net income. Last 3 years have been very strong, but do bear in mind what the CEO as well as the chief executive have said. 2024 has been a struggle based on the geopolitical volatility, weakening in the consumer environment, and they do expect some of that to continue into 2025. Total sales, well, it has increased by 70%, and what they have also done is return some excess cash to shareholder pockets through those share buybacks. Very minimal, very inconsistent, but something just worth noting. We then have the ROIC, one of my favorite metrics, 10% or more, or 12 if you want to be industry specific. Give us that faith that management are able to effectively allocate their capital. Consistently above 12, always a great sign, and from the lows of 2020, it has started to increase, so that is something very nice to note. Margins as well looking good, above 16% for consumer staples, consistently above that, and pretty much consistently at a level of around 30%, so that is nice to note. And the free cash flow margin, whilst it isn't very consistent or an increasing trend, it is still well above the 7% on a year-on-year basis. 14% on a trailing 12-month also does look respectable. We then move to the net debt to EBITDA, the earnings before the interest, tax, depreciation, amortization, below 4 for consumer staples. Remember, these numbers that you do see below are the number of years it would take the company to pay off all of their debt net of cash on hand. And why this is important? Well, it correlates to balance sheet strength, dividend safety. 2.61 in 23, expected to increase in 2024, so do bear that in mind. But based on this information, it still looks like that dividend is safe, and we will take an in-depth look at essentially the balance sheet just to confirm that. Now, also, just to let you know, we have released our latest articles. We have one for those that are paid members as well, where we run through August undervalued dividend stocks. And for those that have been subscribed, you will get this spreadsheet where we run through 35 of those dividend stocks. And for each one, I do discuss whether or not they're in my portfolio. As you can see, an example, the first one being Visa. There are also many other articles that you can get just for subscribing, so do click on that pinned comment below. As we mentioned, we want to take a look at both revenue as well as the bottom line net income. As we said, the revenue has been increasing year on year, a little bit inconsistently as depicted by this graph, but nice to note from the lows of 2020, it has started to increase. Hopefully we can see that momentum continue, but it does look to be unlikely for at least the next year or two, given those comments by management. Now the bottom line, as we can see first graphically, very inconsistent. In fact, the drop from 2019 to 2020, it is nice to note it has recovered and bounced back sharply and has been an increasing trend. But do bear in mind, this isn't a company that you will get massive amounts of consistency, as we have seen throughout. 3.8 billion in 2014, 4.7 in 2023. We then draw your attention to the balance sheet. As we said, a quick health check. 1.1 billion of cash and short-term investments in 2014, 1.5 in their latest quarterly report. So a marginal increase, but again, very inconsistent over the longer term. And it doesn't necessarily mean that is a bad thing, which is why we always compare it to the total debt, both numerically and as always, directionally. So in terms of the total debt, it has increased 16.3 billion in 2014 to around 22 in that quarterly report. So look, it has increased. As we saw, the net debt to EBITDA is expected to increase as well. So something that we do need to factor in, and probably we will allocate a margin of safety for this basis. We then just want to take a quick recap of this company before we look at some gradings over the last year. Now, when the market does open, this will be a larger loss. As we did say, it is just down around 9% so far. And over the last 10 years, it is up only 11%. Not great for any return of investment. And we do note all-time highs did sit at $220 December 21. We're talking nearly 3 years ago. In terms of the yield, as we said, when the market opens, this will be marginally higher. And when we look towards the rating, a buy from Seeking Alpha, a hold from Wall Street with a sell from Quant. Now let's take a look at some of the gradings. The first thing to note is that they do get a C-. When we look at the PE sitting around 20 or just under that, it is marginally higher than the sector median of 19. So with the drop today expected, we will believe this will be trading at a very marginal discount. And when we take a look, pretty much any other valuation method you want to see, they are trading at a premium to the market. We then draw your attention to the growth grade, where they get another very poor rating of D-. Year on year, nice to note, around 7%, with the sector median at 2.3. Moving forwards, just under 4%, the sector itself around 3.65, so pretty much bang in line. And when we look at any of the other metrics, we can see looking underwhelming, as it does seem to be underperforming the sector as a whole. The other thing that we will point out, very poor, the earnings per share moving forwards over the next 3 to 5 years, 1.3% expected, with the market as a whole just under 8%. We then take a look at the profitability. Well, nice to note, they are strong in one element at least. An A with that regard, gross profit margin just above 60%, significantly better than the sector median. Bottom line as well, 20%. That is fairly strong in my opinion, with the sector at 4.51. And one thing that they do outperform significantly is that cash from operations, 4.5 billion, with the sector around 800 million. So as a quick recap for this part, a buy from Seeking Alpha, a hold from Wall Street, and a sell from Quant. In terms of valuation, C-, growth D-, and profitability an A. Now, one thing we always like to do, compare it to how it's performed against others in the sector. Are there any issues we can note as a whole with the industry? We have Constellation Brands, Pernod Ricard, as well as a few very well-known others. And what we noticed over the last year, now this is total return including dividends reinvested, that DEO is actually the second best performing, which tells us a lot. That every other company in this industry has had a negative performance over the last year, and that does include reinvesting those dividends. When we expand it to over the last 5 years, we can see DEO in the mid-performing negative 12%, but again, the majority, 4 out of the 6, have had a negative performance. And when we look over the last 10 years, we can see DEO up 41%, pretty poor over a 10-year period in all honesty. Doesn't mean it will happen over the next 10, because past performance is an indicator of the future, but just something to bear in mind. And we can see 2 companies that have performed fairly decently. We have STZ as well as MGPI looking very strong. So just bear those considerations in mind when looking at this as an investment. And ultimately, what we would say, granted it hasn't outperformed the S&P over the last year, as we can clearly see, negative 23 versus 19, and the same to be said over the last 10 years, a massive outperformance by the S&P versus DEO. Just bear in mind this as one of those things to consider. Do you believe moving forwards it will be able to outperform? It hasn't done it historically, but doesn't mean it won't be able to do it again. Otherwise, do look at low-cost ETFs like VO, and I'm sure there are many others that people can write in the comments. Now, before we look at the valuation, we just want to look at institutional ownership. It sits around 9%, with around 700 million worth of sales by the institutions over the last year, but pretty much double the amount of buying during the same time period. And what we can in fact see, again, the same is relevant in Q2, the more recent data that we have, double the amount of buys than sells. You have to go back to around Q3 of 2023 to see the opposite. Now, we shouldn't really rely on this information to make our own investment decisions. Always do your own due diligence, take a look at your investment thesis, but interesting to note that the institutions are still buying this company fairly consistently more than they are selling. Now let's jump into the valuation model, and as always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. First thing to note then, our intrinsic value of $142 isn't too dissimilar from Wall Street, where they have 143 with around 18% upside. Now what we always do is we run it through the different models. So the first one is the multiples valuation, where we have the average PE multiplied by the EPS of DEO to give us our first undervalued signal, as it is higher than the current market value. Do bear in mind that we don't look at any of these models in isolation. We then run it through the dividend discount model, where we have the average growth of 4.15%. We have gone a little bit higher, but that is also lower than the more recent increase of 5% to give a second undervaluation signal. We then put it through the DCF model, where we have the free cash flow year on year, we have the growth rate in line with management targets moving forwards, and the discount rate to give us the present value of future free cash flows and terminal value. Add together the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see here, another marginal undervaluation signal. So the intrinsic value is purely the average of these three models, and don't forget you can click on the pinned comment below to grab a copy and put your own numbers through, whether it's for DEO or any other companies. So what we always like to do on top of this is have a margin of safety, and we always start off with 10%, and we execute on this if we believe it meets our three golden criteria: a wide moat, strong financial metrics, and good forward-looking data. So at 10%, a buy at $128. We then keep going till it's near the current trading price, and today's episode you could argue around a 15% MOS based on the value right now. Now, my personal opinion, that isn't enough to consider this company. It has had a lot of issues just over the last few years, and it may take them some time to really improve those numbers. But as always, do your own due diligence, consider the issues that they have had from that earnings report that did get released today, and let me know your thoughts below. Now, for those looking at a 20% margin of safety around $113, and those looking at 25% around $106. Now, it will be interesting to see where this share price gets to by today when it does open, if it will go significantly lower, or in fact it will start to rebound. As we said though, in conclusion for today, it does hit a 15% MOS with around 18% upside over the next year. Don't forget, if you do want to see some very large undervalued companies, do check out the newsletter. You can sign up on the pinned comment below. And as always, for our weekly buys and sells, do come and join us in the Patreon. As always, enjoy the day and see you all on the next one.